Picture this. A young man stands in a Texas cotton warehouse in 1895, watching buyers and sellers negotiate over crop prices. He has no formal education beyond third grade. His family is so poor, he walks 7 miles to school before his father pulls him out to work the fields. No economics training, no university degree, no Wall Street connections. Just a Bible his mother taught him to read and an obsession with patterns he sees repeating in the cotton market. That young man would go on to predict the exact month of the greatest stock market crash in history, decades before it happened. He would develop a system of market timing so precise that nearly a century after his death, traders around the world still study his methods, and according to his calculations, we are standing at the threshold of another major turning point, one that his cycles identified more than 100 years ago. This is the story of William Delbert Gann and the mathematical framework he built that some believe has been forecasting market crashes with eerie accuracy since 1875. But here's what makes this different from every other market prediction you've heard. Gann didn't claim to see the future through supernatural means. He claimed to have discovered natural laws governing market movements, cycles as predictable as the seasons, as regular as the tides. And when you examine the historical record, when you look at what he actually predicted, and when those predictions came true, you discover something that should make every investor pay attention. Because if Gann's cycles work the way he claimed they do, then 2025 and 2026 aren't just another couple of years in the market. They're the convergence point of multiple long-term cycles, the kind of alignment that historically has preceded the most devastating market crashes and the most profitable opportunities for those positioned correctly. Let me show you why this matters, how these cycles work, and what the historical evidence actually says about their accuracy. William Delbert Gann was born on June 6, 1878, in Lufkin, Texas. Not 1875 as some sources claim, but 1878. This distinction matters because Gann's entire methodology was built on precision, on exact timing, on getting the details right. His father, Samuel Houston Gann, owned a cotton ranch along the Neches River. This was cotton country, where the economy rose and fell with crop prices, where farmers and merchants lived and died by their ability to predict market movements. Young William was the first of 11 children in a family that struggled financially. His mother, Susan Rebecca Gann, was deeply religious and taught him to read using the only book they owned, the Bible. She wanted him to become a minister. His father wanted him in the cotton fields. Neither got exactly what they wanted, but both influences would shape the trading methodology Gann would eventually develop. The family's poverty meant William's formal education ended after just 3 years of Rhodes grammar school. He never attended high school, but poverty also meant he was working in the cotton warehouses of Angelina County as a teenager, watching the daily fluctuations in cotton prices, observing how buyers and sellers reacted to news about weather, crop yields, and market conditions. This wasn't academic learning. This was practical, visceral experience with how markets actually function. At 16, Gann obtained what was called a miner's release, basically a legal document allowing him to leave school and seek employment. His first job was as a news butcher on the passenger trains running between Texarkana and Tyler, Texas. He sold newspapers, food, and goods to passengers. It required quick thinking, aggressive salesmanship, and the ability to read people. These skills, the ability to gauge sentiment and act decisively, would later become central to his trading approach. But it was his time in the cotton warehouses and brokerage offices of Texarkana that truly shaped his thinking. Cotton was the economic lifeblood of East Texas. Gann spent his teenage years immersed in the mechanics of commodity trading, learning how prices moved, how speculators thought, how markets reacted to supply and demand. He attended business school at night while working as a cotton broker during the day, slowly building the knowledge base that would later make him famous. In 1902, at age 24, Gann made his first commodity trade in cotton. It was a small profit, but it marked the beginning of what would become a legendary, if controversial, career. A year later, in 1903, he moved to New York City. He was 25 years old, had minimal formal education, but possessed an almost obsessive drive to understand market movements. He worked for Wall Street brokerage firms, trading for clients while developing his own theories about market behavior. Then came 1908, the year that would change everything. Gann claimed that on August 8, 1908, he made what he called his greatest mathematical discovery for predicting market trends. He called it the master time factor. What exactly was this discovery? Gann was deliberately cryptic about it, writing in an esoteric style that many found impossible to follow. But based on documents that surfaced after his death and analysis by researchers who have spent decades studying his work, scholars believe the master time factor was related to planetary cycles, particularly a cycle of approximately 18.6 years tied to the moon's north node. This sounds like astrology, and in many ways it was. But Gann framed it differently. He believed markets moved according to natural laws, mathematical principles that could be discovered through the study of geometry, astronomy, and ancient mathematics. He spent years researching in the British Museum in London, traveling to Egypt and India, studying texts on Pythagoras, Euclid, and ancient Eastern philosophy. He was looking for the mathematical constants that governed market behavior, the way gravity governs planetary motion. Whether or not you believe in astrological influences on markets, Gann's track record in the years following his 1908 discovery is documented. In October 1909, Richard D. Wyckoff, the editor of Ticker and Investment Digest, and one of the most respected financial writers of his era, published a detailed article about Gann's trading abilities. To verify Gann's claims, Wyckoff had an independent observer monitor Gann's trading throughout the month of October 1909. The results were remarkable. Over 25 market days, Gann made 286 trades. Of those, 264 were profitable. That's a success rate of over 90%. During one documented period, Gann turned $300 into $25,000 in 3 months. In another account, he started with $130 and made $12,000 in 30 days. These weren't claims Gann made himself. These were figures verified by independent observers and published in a respected financial publication. But what made Gann truly famous, what cemented his reputation as perhaps the greatest market forecaster who ever lived, was what happened in November 1928. That month, Gann released his annual forecast for 1929 to his newsletter subscribers. Remember, this was November 1928. The stock market was in the midst of one of the greatest bull runs in history. Optimism was universal. Everyone believed the good times would last forever. Stock prices were climbing to levels that seemed to defy gravity. The public was pouring money into the market on margin, borrowing heavily to buy stocks because everyone knew prices would keep rising. Into this environment of euphoria and certainty, Gann published a forecast that went against everything the consensus believed. He predicted that the market would continue rising into early 1929, reaching new highs until around April. Then there would be a sharp break, a decline that would shake weak holders. After that, prices would recover and push to final highs. But then, Gann wrote, the market would top around September 3, 1929. And after that top, he predicted, would come the biggest market crash in history. He didn't hedge, he didn't qualify. He gave specific months, specific pattern predictions, and a clear warning that a devastating crash was coming. This forecast was published and distributed to subscribers in November 1928, nearly a year before the events he was predicting. Now, here's what actually happened. The market did rise into early 1929. It did experience a sharp decline in April and May, exactly as Gann predicted. Prices then recovered and reached new all-time highs. The final peak came on September 3, 1929, the exact date Gann had specified nearly a year earlier. On October 24, 1929, less than 2 months after Gann's predicted top, the market crashed. October 28 and 29, the days that became known as Black Thursday and Black Tuesday, saw catastrophic declines. The Dow Jones Industrial Average lost nearly 25% of its value in 2 days. By the time the bear market reached its bottom in 1932, stocks had lost nearly 90% of their peak value. It was the worst crash in market history, exactly as Gann had predicted. Now, I need to be clear here. The September 3rd peak date was incredibly precise, but the crash itself happened about 7 weeks later in late October. Some Gann supporters point to this near-perfect timing as proof of his system's validity. Critics note that predicting a crash within a few weeks is still different from pinpointing the exact day. But even the critics have to acknowledge that predicting a specific market top within weeks, nearly a year in advance, during a time when universal sentiment was bullish, is extraordinary. This wasn't Gann's only accurate prediction. In 1914, early in the year, he predicted the outbreak of World War I and a panic in stocks. The war began in August 1914, and markets crashed. In March 1918, Gann successfully predicted the end of World War I and the abdication of the German Kaiser. The armistice was signed on November 11, 1918. Major newspapers, including the New York Times, acknowledged these predictions. But predictions are one thing, profitability is another. And this is where Gann's story gets complicated, where the legend and the reality start to diverge in ways that are crucial for understanding whether his system actually works. The legend says Gann made over $50 million from trading, an enormous fortune in his era. He was said to own private airplanes, a yacht with a crew, luxury estates. He charged $5,000 for his advanced trading courses in the 1940s, equivalent to about $50,000 today. He lived like a man who had cracked the market's code and extracted massive wealth. But there's another version of the story. Alexander Elder, a well-respected trading psychologist and author, interviewed Gann's son, John Gann, who worked as an analyst for a Boston bank. According to Elder, John Gann told him that his famous father could not support his family through trading. Instead, Gann made his living by writing books and selling instructional courses. When W.D. Gann died in 1955, his estate, including his house, was valued at slightly over $100,000. That's a comfortable amount, but nowhere near $50 million. Larry Williams, another famous trader and author, also reported meeting John Gann. Williams said that John Gann was still working a regular job, cold calling customers to trade. If his father had truly made tens of millions from trading, why would the son need to work at all, much less in a basic sales position? Further complicating Gann's legacy, some people who knew him personally suggested he was more successful as a promoter than as a trader. F.B. Thatcher, who had been Gann's promoter and advance man, reportedly said that Gann was just a good promoter, not necessarily a good stock trader. These contradictory accounts create a puzzle. How do we reconcile the documented predictions, the verified trading results from 1909, the massive following Gann developed, with the evidence that he may not have accumulated the fortune legend claims? Here's one possibility. Gann may have been genuinely skilled at forecasting market turning points using his cycle analysis, but less skilled at translating those forecasts into consistent trading profits. Knowing when a market will top is valuable, but it's different from knowing how to position sizing correctly, manage risk, handle the psychological pressure of actually putting money at risk based on predictions. Many brilliant analysts are mediocre traders. Conversely, many successful traders have mediocre analytical frameworks, but excellent risk management and discipline. Another possibility is that Gann made substantial sums during certain periods, like the 1929 crash and the 1930s depression, but lost much of it in other periods or spent it on his lavish lifestyle and multiple divorces. His financial situation at death might not reflect his peak earnings, or perhaps the truth is somewhere in between. He was successful enough to live well and charge premium prices for his courses, but not successful enough to build the generational wealth the legend describes. But here's why this matters for us today. Whether or not Gann himself profited massively from his system is less important than whether the system itself has predictive value. If the cycles Gann identified actually work, if they consistently mark major market turning points, then the system has value regardless of whether Gann personally executed it perfectly. So let's examine the cycles themselves and see what the historical record shows. Gann identified several major cycles. The most important, according to his writings, were the 90-year cycle, the 60-year cycle, the 45-year cycle, the 30-year cycle, and the 20-year cycle. But underlying all of these was what Gann called his financial timetable, constructed in 1908 and based on an 18.6-year cycle related to the Moon's north node. The Moon's north node is an astronomical phenomenon. The Moon's orbit around Earth doesn't sit perfectly flat relative to Earth's orbit around the Sun. Instead, it's tilted. The points where the Moon's orbit crosses the plane of Earth's orbit are called nodes. The north node is one of these crossing points, and it moves backward through the zodiac, completing a full cycle approximately every 18.6 years. This cycle was known to ancient astronomers. What Gann claimed to discover was that this astronomical cycle correlated with major market turning points. To construct his timetable, Gann alternated intervals of 19 years and 18 years, which average out to 18.5 years, very close to the actual 18.6-year lunar node cycle. He mapped these intervals starting from 1784 and extending forward more than a century. At each interval, according to Gann, the market would experience either a major peak or a major trough. The specific character, peak or trough, would depend on where the cycle fell in relation to longer cycles. Now, let's test this. Let's look at major market turning points and see if they align with Gann's 18.6-year intervals. Starting from a known crash, the Panic of 1837, we can add 18.6 years repeatedly and see what we get. The Panic of 1837, a severe recession. Add 18.6 years and you get 1855 to 1856, a period of market panic and financial crisis. Add another 18.6 years and you get 1873 to 1874, the Panic of 1873, which triggered a depression lasting years. Add another cycle and you get 1891 to 1893, the Panic of 1893, another severe economic crisis. Continue forward, 1911 to 1912, a period of significant market volatility and recession. Add another cycle and you reach 1929 to 1931, the Great Crash and the beginning of the Great Depression. Another cycle brings us to 1948 to 1950, a period of post-war adjustment and volatility. Forward again to 1966 to 1968, a major market peak followed by a difficult decade. Another cycle reaches 1984 to 1987, and 1987 saw the Black Monday crash, the single worst one-day decline in market history. Add another 18.6 years and you arrive at 2002 to 2004. The stock market bottomed in October 2002 after the dot-com crash. That marked the end of a brutal bear market and the beginning of a new bull market. One more cycle forward brings us to 2020 to 2022. In March 2020, markets crashed due to COVID-19. In 2022, markets experienced a significant correction. And here's where it gets interesting for us right now. The next 18.6-year cycle from the 2020 low brings us to late 2025 into 2026. Now, this is just one cycle. Let's look at Gann's longer cycles. Gann placed enormous emphasis on the 60-year cycle, which he called the Great Cycle or Master Time Period. He stated that this was the greatest and most important cycle of all. To see why, Gann pointed to specific historical examples. He wrote that you should refer to the war period from 1861 to 1869 and the panic following 1869. Then, 60 years later, 1921 to 1929, came the greatest bull market in history, followed by the greatest panic in history. Let's examine this. The period from 1861 to 1869 encompassed the American Civil War and the immediate aftermath. The economy was dominated by war spending, inflation from printing money to fund the war, and then the difficult transition to a peacetime economy. In 1869, Black Friday occurred, a major financial panic when Jay Gould and James Fisk attempted to corner the gold market, causing a crash. Exactly 60 years later, from 1921 to 1929, the U.S. experienced the Roaring Twenties, the greatest bull market up to that point in history. Stock prices more than tripled. Speculation reached fever pitch. And then came the 1929 crash, which Gann had predicted using his annual forecasting method. The 60-year interval from one major peak to panic sequence to another was exact. But here's the critical question. Do these cycles continue to work going forward? From the 1929 crash, add 60 years and you reach 1989. Was there a significant market event in 1989? Actually, yes. October 1989 saw a major market drop, though not a full crash. More significantly, 1989 was when Gann himself had noted that his financial timetable would need to be recalibrated. Some Gann analysts believe this was because the alignment between the calendar-based intervals and the actual astronomical cycle needed adjustment at that point. From 1989, add another 60 years and you reach 2049. We don't know what will happen then, but there's another application of the 60-year cycle that's more immediately relevant. Some Gann analysts point to 1966 as the peak of the post-war secular bull market. From 1966, add 60 years and you get 2026. Others note that the market bottom in 1942 was 60 years before the 2002 bottom, and 60 years from 1982, the beginning of the great bull market, brings us to 2042. Now, let's look at the 90-year cycle. Gann stated that the 90-year cycle was the longest and most powerful, a major determinant of long-term economic and social trends. From the panic of 1837, add 90 years and you reach 1927, just before the 1929 crash. From 1929, add 90 years and you reach 2019. Did anything significant happen in 2019? In many Gann analysts' view, 2019 represented a major market peak. The S&P 500 reached new highs in late 2019, and then in 2020 the COVID crash hit. Some argue that the crash should have come in 2019 based on the 90-year cycle from 1929, and they view the fact that it arrived in early 2020 as close enough, given that cycles don't always hit exact dates, but rather create windows of vulnerability. Others argue that the COVID crash was an external event unrelated to internal market cycles, and that the true turning point is still ahead. Another critical cycle in Gann's system is the 45-year cycle. Gann noted that 45 degrees represents half of 90 degrees, and therefore 45 years represents half of the 90-year cycle. He stated that this cycle was particularly important for identifying intermediate trend changes. From the 1974 market bottom, which occurred during the oil crisis and stagflation, add 45 years and you reach 2019. From the 1980 peak in gold and silver, add 45 years and you reach 2025. You can see how these cycles are starting to cluster around the same time periods, 2019 through 2026. Multiple cycles of different lengths are converging. In Gann's methodology, when multiple cycles align, when several different time periods all point to the same window, that's when the most significant market events tend to occur. The strongest market moves happen when multiple cycles line up together. So what does all of this mean for 2025 and 2026? Based on Gann's cycle analysis, particularly the 18.6-year financial timetable, we are entering a critical window. The cycle from the March 2020 COVID crash bottom suggests that late 2025 into 2026 could mark another major turning point. Whether that's a top before a decline or a bottom before a rally depends on the character of the move leading into that period. But let's be very clear about something. These are not certainties. They are probabilistic frameworks based on historical patterns. The cycles don't guarantee what will happen. They indicate when something is more likely to happen. Markets could continue rising through this period. The cycles could be early or late. External events, policy decisions, technological disruptions, any number of factors could override or modify the cycle's influence. What the cycles do is create a framework for attention, a reason to be particularly alert during specific time windows. If you understand that late 2025 into 2026 represents a potential turning point based on multiple cycle confluences, you can watch for confirming signals. If the market shows signs of exhaustion, if valuations reach extremes, if sentiment becomes universally bullish or bearish, if margin debt or other risk indicators flash warnings, then the cycle analysis gives you additional reason to act. This is how sophisticated analysts use cycle analysis, not as a magic bullet that tells you exactly what will happen, but as one input among many. When fundamental analysis, technical analysis, sentiment indicators, and cycle analysis all point in the same direction, the probability of a significant move increases substantially. Let's talk about how you might apply this practically. If historical patterns hold, and if the cycles identified by Gann continue to mark major turning points, what would we expect to see as we approach late 2025 and into 2026? First, watch for the character of the market move leading into the cycle window. If markets have been rising strongly, if enthusiasm is high, if speculation has reached extreme levels, then the cycle window is more likely to mark a top. Conversely, if markets have been declining, if fear is elevated, if pessimism dominates, then the cycle window might mark a bottom. Second, pay attention to confirming technical signals. Gann didn't just use time cycles, he also developed extensive price analysis techniques, including what became known as Gann angles, the square of 9 calculator, and various geometric relationships between price and time. When a key time cycle aligns with a significant price level, when both time and price are indicating a potential reversal point, that's when Gann believed the highest probability setups occurred. Third, consider the broader economic and market environment. Cycles don't operate in a vacuum. They interact with monetary policy, fiscal policy, international developments, technological change, demographic trends. If a cycle window arrives during a period of policy tightening, when the Federal Reserve is raising interest rates or reducing liquidity, the cycle's bearish potential is amplified. If a cycle low arrives when policymakers are responding with stimulus, the recovery potential is enhanced. Fourth, manage risk appropriately. Even if you believe strongly in the cycle analysis, even if multiple indicators are aligned, markets can remain irrational longer than you can remain solvent. Position sizing, stop losses, diversification, these basic risk management principles become even more important when trying to position for a major cycle turning point. Many traders who correctly identified major tops or bottoms still lost money because they were too early, too concentrated, or used too much leverage. Now, let's address the elephant in the room. Is this just astrology dressed up as market analysis? Are we really supposed to believe that the position of the moon's nodes relative to the zodiac has any actual influence on stock prices? This is where even many serious traders struggle with Gann's work. The astronomical and astrological components seem at odds with rational market analysis. Here's one way to think about it. Gann's cycles work to the extent they work, not because the moon actually controls stock prices. They work because they capture recurring patterns in human behavior and economic activity. The 18.6-year cycle, for instance, is close to the length of certain credit cycles, real estate cycles, and demographic cycles that economists have documented. Phil Anderson, a real estate cycle researcher in Australia, wrote extensively about an 18-year property cycle that he identified going back to the 1600s in England. He found that real estate markets tend to boom and bust in regular intervals of roughly 18 years. These cycles aren't caused by astronomy. They're caused by the interaction of credit availability, construction timelines, demographic waves of buyers, and the inevitable overshoot and correction that characterizes any cycle of speculative mania. Similarly, the 60-year cycle might not work because of anything mystical, but because 60 years represents roughly 3 human generations. A generation that experienced a major crash firsthand becomes risk-averse. They teach their children to be cautious, but their grandchildren, who never experienced the crash, become willing to take risks again. 60 years is roughly the length of time it takes for societal memory of major financial trauma to fade enough that the same mistakes get repeated. The 90-year cycle might correlate with even longer institutional and political cycles, the lifetime of major policy regimes or currency systems. From this perspective, Gann's genius wasn't discovering that planets control markets. His genius was identifying and tracking cycles that capture repeating patterns in mass human behavior, and then finding astronomical phenomena that had similar periodicities, which gave him a precise timing mechanism. Whether you accept the astronomical framework or not, the empirical question remains. Do these cycles actually mark major market turning points with enough consistency to be useful? The historical record is mixed but intriguing. The 18.6-year cycle has marked or closely approximated major market events in 1837, 1856, 1873, 1893, 1912, 1929, 1948, 1966, 1987, 2002, and 2020. That's 11 out of 11 major cycle points showing significant market events. It's a remarkable batting average for any predictive framework. The 60-year cycle has fewer data points simply because it's longer, but the 1869 to 1929 alignment that Gann emphasized is undeniable. The 90-year cycle from 1929 to 2019 brought us to the threshold of the COVID crash, though whether that counts as a hit depends on how much tolerance you allow for timing. But here's the crucial caveat. These cycles don't tell you magnitude. Knowing that a turning point is likely doesn't tell you whether it will be a 10% correction or a 50% crash. They don't tell you duration. A cycle low might mark the start of a 3-month rally or a 10-year bull market. And most importantly, they don't account for the unprecedented nature of current conditions. We are living through a period unlike any other in financial history. Central banks have expanded their balance sheets to levels never before seen. Government debt as a percentage of GDP is at peacetime records. Interest rates have been suppressed for over a decade. Stock valuations by many measures are at or near all-time extremes. The wealth gap is wider than at any point since the Gilded Age. Technology is transforming economic relationships in ways we don't fully understand. Any of these factors could override historical cycle patterns, or they could amplify them. When a cycle turning point arrives during a period of extreme imbalances, the subsequent adjustment can be far more severe than historical averages would suggest. Conversely, massive policy intervention can defer or dampen cycle effects, though typically at the cost of creating even larger imbalances that eventually correct even more violently. So what should you do with this information? First, understand that Gann's cycles provide a framework, not a forecast. They tell you when to pay attention, when to increase vigilance, when to look for confirming signals from other methodologies. Second, combine cycle analysis with fundamental and technical analysis. Look for periods when all three perspectives align. Third, prepare scenarios. If the cycle window marks a major top, what would your portfolio positioning be? If it marks a bottom, how would you position to capture the next bull leg? Fourth, maintain humility. The future is uncertain. Historical patterns inform probabilities, but they don't determine outcomes. Markets can and do behave in ways that violate every historical precedent. Black swans happen. Fifth, focus on risk management over prediction. It's more important to survive wrong forecasts than to maximize gains from correct ones. Position sizing, diversification, and stop losses matter more than timing precision. What makes Gann's story so compelling, whether or not you believe in his methodology, is what it represents about the search for patterns in apparent randomness, the human drive to find order in chaos. Markets feel random. Day-to-day moves seem impossible to predict, and most participants lose money. In that environment, the idea that someone discovered a hidden order, a mathematical key that unlocks future price movements, is intensely appealing. Maybe Gann really did discover something profound about market structure. Maybe his cycles genuinely mark turning points with better than random accuracy. Or maybe humans are pattern-seeking creatures who find cycles where none exist, who remember the hits and forget the misses, who construct narratives that impose meaning on random data. The truth probably lies somewhere between these extremes. What we can say with certainty is that late 2025 into 2026 represents a confluence of multiple Gann cycles. Whether that means anything for actual market behavior, we'll find out soon enough. If you're watching these cycles, the next 18 months will be the test. If major turning points arrive during the windows the cycles identify, it will add weight to the methodology. If they don't, it will raise further questions about whether the patterns are real or illusory. In the end, Gann's legacy isn't about whether he personally made $50 million or whether his cycles perfectly predict every market turn. His legacy is the framework he provided for thinking about market structure as cyclical rather than random, for paying attention to time as well as price, for recognizing that history doesn't repeat exactly, but it often rhymes in ways that create exploitable patterns for those paying attention. If you want to understand how power actually works in markets, you have to grapple with the tension between the efficient market hypothesis, which says all information is instantly priced in and prediction is impossible, and the observable reality that certain patterns do seem to repeat, that cycles do seem to exist, that those who understand market structure seem to do better than random chance would allow. Gann represents an extreme version of the pattern recognition approach. But whether his specific cycles work or not, the broader principle that markets move in rhythms, that there are seasons to market behavior just as there are seasons to agriculture, this principle is worth taking seriously. Because even if the specific 18.6-year cycle is just a coincidence, even if the 60 and 90-year patterns don't continue forward perfectly, the underlying insight that markets are not random walk processes, but complex systems that exhibit repeating behaviors at multiple timescales, that insight is almost certainly correct. As we stand here in late 2025 approaching 2026, the test is in front of us. The cycles say this period matters. Will they be proven right? Time will tell. But whether or not the specific dates align, whether or not the turns happen exactly when the cycles suggest, the framework Gann provided remains valuable for thinking about when to be cautious and when to be aggressive, when to trust the trend, and when to prepare for reversal. If this changed how you see market cycles and the possibility that market movements aren't purely random but follow deeper patterns that can be identified through careful study of history and mathematics, then you're starting to see markets the way the most successful long-term investors see them. Subscribe if you want to keep exploring how the machine actually works, because they're not teaching you this in business school. They're teaching you that markets are efficient and timing is impossible. But the people who built fortunes in markets, from Gann to Soros to Druckenmiller, they all understood that markets move in cycles, that history provides clues about the future, and that the greatest opportunities come from recognizing when a major cycle is about to turn. The cycle says the turn is coming. The only question is whether you'll be positioned to profit from it or caught on the wrong side when it arrives.